I'm 63 years old with $2.5 million saved for retirement, all inside of a traditional 401k. Do I have a tax problem? For many pre retirees, this is a question they ask themselves often because for many, they unintentionally put themselves in this situation thinking that they were playing the tax game correctly. They got a job. They figured while I'm working, I'm going to be earning a good income, which will put me in a higher tax bracket. So I'm going to save all of my retirement money in a traditional 401k, avoid tax on that savings, retire. After I'm retired, I will be in a lower tax bracket. And at that point, then I will be able to spend that pre tax money in a lower bracket in retirement forever, resulting in a net tax benefit to me. For some retirees, this is exactly how it plays out. But for many others, that big traditional 401k savings account could result in a giant tax bomb, and it's up to you to disarm it before it ends up hurting your future retirement. Hi, my name is Derek Delaney. I am a certified financial planner, and this is the type of work I do for my clients for a living. So let's talk about why tax planning is so important and what opportunities pre-retirees and newly retirees have to limit their overall lifetime tax bill. Let's take a look at this example. It is a couple who wants to retire at 63 years old. They have $2.5 million saved for retirement, and they're getting to the point where they have to determine what or if any tax opportunities are available to them to reduce their overall lifetime tax bill. And you can see here, asking that question and digging deeper into that question becomes very, very beneficial because depending on how you handle your tax situation and how you handle your distribution strategy, meaning where you pull money from in retirement, could be the difference in tens of thousands or hundreds of thousands, or for some people, seven figures in total tax savings and future net legacy. So just in this example alone, the difference in converting traditional 401k money to a Roth IRA up to the 22% federal income tax bracket compared to just withdrawing all of that 401k every single year at whatever withdrawal needs they have considering their spending plan will result in a difference of $645,000 in total taxes saved in present value terms, in almost $350,000 in total net legacy in present value terms. And we could go, hey, what does that mean in future value terms? And just the difference between doing a Roth conversion in a 22% bracket and pulling it all out in a pro rata manner, meaning just withdrawing all of it from the 401k at whatever amount you need that year and doing nothing else, is the difference in over $1.8 million in future taxes saved in almost $1 million in total net legacy. So this is extremely important, and the opportunity cost of not doing anything is very, very high in this example, and it's why tax planning is so absolutely crucial on an ongoing basis for most pre-retirees and newly retirees. So let's take a look at why tax planning can be such a significant benefit for most people. And the answer to that is, if you do nothing in retirement and you just want to pull all of your pre-tax money out at whatever amount you need to satisfy your retirement living expenses, and your retirement living expenses aren't extraordinarily high, it means that earlier on in retirement, in this example, you can see here that these bars represent total income in a year, and the different color of bars represent the different types of income sources that this specific couple in retirement will experience. You can see here that earlier in retirement, they don't spend a lot of money. And then they hit a magic age of 73 in 2040 and 2041, which starts what we call required minimum distributions. And what required minimum distributions are is basically the IRS says, we want you to spend all of your pre-tax money before you die, and in order for us to ensure that that happens, we're going to force you to spend a specific amount of money every single year after you reach the required age of 73. And the specific amount we're going to force you to spend is we're going to take your deferred retirement savings money, so 401ks, IRAs, and we're going to take the balance of that on December 31st, and we're going to divide that number by how long we think you're going to live. And that's the amount of money you're going to be forced to have to take out the next year. So if you have $2 million in December 31st and the IRS thinks you have 20 years left to live, you take $2 million, divide it by 20, and that is the amount you're going to be forced to take out that next year. And the real issue comes in when those retirement account balances continue to grow over time, and the denominator in that equation, which is how long the IRS thinks you're going to live, continues to drop every single year. So bigger numerator, smaller denominator means a larger continuous amount you're going to be forced to take out of your retirement accounts, whether you need it or not. So when you get to an old age, in this example, 2058, you can see that the required minimum distribution amount is almost $450,000. That would put them well under that 24% bracket, meaning their total income at that point could be close to almost $750,000. Now, I don't know about you, and I don't know what your retirement income goals are, but for most people, as they age into their 80s and lower 90s, their income need is not as high. So them being forced to take out hundreds of thousands of dollars out of their IRA or 401k in retirement when they don't need it is not necessarily the greatest move for them, and it's not one they wish they, or not one they want to make. And usually for those individuals, it's one of the reasons why they wish they would have implemented some sort of tax planning strategy much earlier in retirement. So in this example, let's move forward and let's talk about what you can do to mitigate those future RMDs. And for a lot of people, you jump to the strategy of doing a Roth conversion like we talked about here. But there are a number of different Roth conversion strategies or just general withdrawal strategies you can utilize. So if you look at the strategies here, you can see that you can Roth convert up to any of the federal income tax brackets. You can Roth convert up to different IRMA brackets, which control how much Medicare premium you pay 2 years from that point. And you can see the options are vast in the difference between the best option, which in this example is converting up to the 22% bracket, and the worst tax situation, which is a maximum 1-year Roth conversion, could be the difference in millions of dollars. So you have to understand what strategy fits best within your retirement plan. And you can't just use the thought of, I'm going to do a Roth conversion at a random amount this year and hope years down the road that was the optimal move. And then the question becomes, well, how long do you have to do a Roth conversion in order for it to pay off? Because longevity and when you die and how long you think you're going to live matters. And in this situation, we can go in and see, hey, the break-even point of when doing this type of strategy compared to just withdrawing money from a pro rata standpoint, the difference when that strategy pays off would be right around 2050, 2051. And you can see here in the 2040s when those Roth or when those RMDs start taking off, not doing anything, just pro-ratably pulling money out of your retirement account with no Roth conversions really start to impact negatively the amount of tax you're going to owe compared to Roth converting in the 22% bracket. So figuring out what your tax plan is and understanding how that tax plan is going to be integrated into your retirement plan, and then having an understanding of long-term, how is that going to be beneficial or not compared to all the other tax planning strategies I have available, can be the difference in 6 or in many cases 7 figures of net legacy and future value total taxes paid for many pre-retirees or newly retirees out there. And I don't know about you, but paying more money to the IRS does not make you more patriotic. So limiting your overall lifetime tax bill just means more money in your pocket long term, which means more money you have the ability to spend in retirement on yourself, or more money your beneficiaries will receive after you die. And in the end, that just means less money the IRS gets, which means you pay your fair share and nothing more, which in my experience is exactly what each pre and newly retired couple wants. So if you're interested in learning how a tax planning strategy or a tax efficient distribution strategy can or maybe cannot be beneficial in your situation, I invite you to schedule time to chat, and I'd be happy to share more about the work I do in this regard to see if it would be beneficial in your specific situation. So click on the link below, schedule your free consultation, and we can talk about all of that and more. Until that future conversation, happy retirement planning.